They are scared. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, a $60 trillion financial system is on the brink as this entire sector comes unraveled. And what I want you to understand is the contagion risk here is huge, as this could easily and rapidly spread through the entire global financial system. And as you know, we're still in Jackson Hole, Wyoming. This morning, we tried to sneak into breakfast ahead of Jay Powell's speech to see if we can get some questions answered. He dodged us, but we're going to keep trying, because what I want you to see in today's show is why policymakers are so afraid. Let's head over to Bloomberg, where he picked today's story up with a headline: China eases home purchase rules and new push to boost the economy. And now the way you should interpret this is outright desperation, because the framing here is, when we start to look at the Chinese banking system, what you see is it's really the Chinese property sector. It's almost one and the same. Where one goes, the other follows, and the risks here are huge, because it wasn't too long ago we were talking about how Xi Jinping wanted to slow down the speculation in the Chinese property sector. He wanted to cool it off, and now all of a sudden we're seeing reversal as the property sector is about to drag down the entire Chinese financial system and take the world right down with it. The country is proposing that local governments can scrap a rule that disqualifies people who've ever had a mortgage, even if fully repaid, from being considered a first-time homebuyer in major cities. Now, you might think, well, that's really not a big deal. It just means they don't have to put quite as much money down. Well, wait till you see it in a bit, because the amount of money that a Chinese investor or consumer has to put down on a home there is outright amazingly large compared to what we see in the US. So if you pull back the reins here and they don't have to put as much money down, the hope is this will turn around the alien real estate sector. But the problem is, it may be too little, too late. China's real estate sector is unraveling, and the risks are spreading to the country's $60 trillion financial system. Their existing policies have failed to sustain a rebound in the property market as price declines across the nation, putting the government's 5% economic target at risk. And yes, this is a huge problem, because as we've talked about, China's economy internally, now remember, externally, it's all about demand from other countries. They're the world's largest exporter. So when you're in that case, your whole manufacturing base is really reliant on the rest of the world, which we already know is slowing down. But internal, inside China, the real estate sector matters. The banking system massively over-leveraged in loans to these property developers. The property developers, as we know, they are a Ponzi scheme. They're massively over-leveraged as well, making promises to build things they don't have the money to do. And on top of that, investors have poured money into the system and now are facing that they're not going to be paid. If the whole system goes, well, there's nothing Beijing's going to be able to do to stop it at all. The government said it will also extend the personal income tax rebates to people who buy new homes within 1 year after selling old homes till the end of 2025. This according to the Ministry of Finance. So here again, you see just complete acts of desperation. Now, they're not going to full panic mode yet, but you can see they're kind of moving that way, because if these policies don't make a dent, well, they're going to have to go bigger. And when they do, it's just a sign that the system is probably already failing, because by the time Beijing gets around to responding, I believe it's going to be far too late. In at least 10 of the biggest cities, home buyers with a mortgage record who don't own a property have been subject to higher down payment requirements and more restrictive borrowing limits. That has suppressed demand, as these people have been treated like second-time home buyers. But check this out. In the capital of Beijing, a second-time buyer, this is amazing, needs to come up with a down payment of as much as 80% of the property's value. The down payment is 40% for first-time buyers. So could you imagine, you're buying your very first home and you purchase it, you want to buy a second home, and the second home you have to put 80% down. Well, and of course, here in America, that would cause outright panic and pandemonium. In China, could you imagine then, if the rules are now officially relaxed, instead of 80% down, it goes to 40. You can see again, these are all acts of desperation to get people to buy property, and here's the reason why. Developers are facing a massive 62 trillion yuan or $8.5 trillion US dollar gap to meet their financial obligations. If you can imagine, those are staggering numbers here. And if they can't meet them, the whole system fails. Beijing obviously realizes this, but doesn't want to go into full crisis mode yet. So they're going to give them a little bit of juice, hopefully bringing people out to buy if it doesn't work. What I again feel is it's too little, too late. And who else validates that? Well, the stock market there in China sees it too. As China's stimulus rally lasts just 10 minutes, if you can imagine that, showing trader gloom. A tepid response speaks to the gloom that has gripped China's equity market in a headline I'll probably have to save for another day, and shows once again that policymakers' efforts to revive investor confidence are falling nothing but short. Down about 10%, an index of Chinese shares listed in Hong Kong is the world's largest performer this month among the 90 equity gauges tracked by Bloomberg. But check this out. Overseas funds have been selling onshore stocks at a record pace, and we've told you, we've made the case that this is going to be an issue here. Is everybody wants out of China. Not only do people that live there want out, they want to get their money out, the rich want their money out, but other investors are looking at this from the outside in saying, you know, maybe it's time to pull our money. And there's one way to capitalize on that, as you can see here from one of our subscribers to our CTA-Timer Pro report who hacked it. You know, we tell people on the long side, but he hacked it to the short side. Here is the ETF FXI. He was looking at the show, as I've told you before, and said, look, I saw the data you were talking about China. It only was a matter of time before the market reacted. He saw here, I'll show you the data. The report said the machines were moving down from their long position and starting to sell off. And sure enough, that would be the entry point. We look to today. Even if you're still holding after this brief rally, it's an 8% gain in a matter of 2.5 trading weeks. If you can imagine what a return. And if this data we're seeing out of China is right and the machines follow what our lead here of our report, they're going to sell even more. So here you can go back to August 10th. Here you can see coming off that long position in FXI, entering a short trade there, and then you can see it's continued to move to a max short position on August 22nd and nearly there. We haven't pulled today's data out for you to see, but you could stay tuned until Sunday's show where we'll have a broad update, of course, on all our machine positioning, but you too can access this amazing report and the historical overlay that we run to give you an edge on where the machines are trading. Link in the description below. It's a mere $30 a month, and when you see what's going on in China and you see trades like that, it's a no-brainer. The market is less sensitive to news at this current stage of what we see here. What's the key right now is letting that downward momentum run out organically, as policies have already turned supportive, but it will take time for the shorts to be exhausted, and that's exactly what our subscribers are hoping for that jumped on that trade. Because what's interesting about this is in a good time when liquidity is being created, when money is being injected into the economy, and I don't mean from central banks, I meant from the banking system itself, good news gets supported by higher equity prices. But when money is being eviscerated from the system, what do you see? Good news, well, you don't see the buyers come in because there isn't enough new money being created to support everything. That's how you know the trend has changed and why Chinese stocks are likely to head lower. But there perhaps are some other reasons investors are turning away. As Country Garden delays bond extension deadline at the last minute. Now, I want you to be thinking is, why would they do this? Why, if they said, you know, we're going to come out and we're going to have this extension, I want you to see what their response is. But what would be the real reason they want to extend the deadline? Let's take a look. The country's former largest builder, now of course due to the valuation is much smaller, is pushing the deadline back to August 31st from August 25th. Seemingly not a big deal, but perhaps a much bigger deal than many want to believe. And that comes just hours before the previous scheduled voting deadline of 10 p.m. And this is interesting because Country Garden, I want you to see this, whose worsening cash crunch has shaken Chinese markets. So again, you get a little bit of a tell here of what maybe the real issue is. Let's keep going. And the payment of 3.9 billion won of outstanding principal into 2026 is what they're trying to stretch out. The delay on the voting deadline, get this, from Country Garden's perspective, is to give sufficient time for the bondholders to discuss and decide on the proposals. Or perhaps it's because Country Garden doesn't have the money to make the next payment and they actually already just need to buy a little more time. And maybe in 5 days they have the money. So when the bondholders agree, because perhaps what Country Garden's also going to do is call some of the biggest ones up and say, hey, by the way, if you don't agree to one of these extensions, you're probably not getting paid anyways. So you better take it and hope in 5 days we've got the money, suggesting, as we know, that things in China's property sector are perhaps far worse than even we think. Some note holders have demanded full repayment by the effective due date of September 4th, and you can't blame them. The first business day following the note's maturity date 2 days earlier. The offering document doesn't say if there are grace periods for the bond, but it doesn't matter. If Country Garden doesn't have the cash, they ain't paying. And meanwhile, a grace period for Country Garden to pay a combined whopping $22.5 million of dollar-denominated note coupons in shortly after the yuan bond is due. And this is where we're going to find out that the global dollar shortage is perhaps even bigger than most people realize, when Country Garden, I'm going to predict, is probably going to miss that payment as well. And it's not just that, it's the downstream effects here as China braces for a $38 billion in losses in the troubled trust sector. So again, we started the show out talking about the risks to the financial system, and I want you to see, the desperation out of Beijing to revive the property market, which is really not enough to do it. And then you're seeing Country Garden on the verge of missing payments and causing pandemonium. And now we shift into the financial sector, and they've got big problems because where one payment comes out of, they're missing it. It goes to these people, but wait till we get a little deeper here. You're going to be surprised. There's going to be a dangerous dance going on between the shadow banks and the banks themselves, and that's going to play out in the second half of this year, and it's going to be very messy. Of course, we're going to see it play out in about the fourth quarter of this year, and perhaps in China we'll see it perhaps even sometime next month, but let's go a little deeper. Trusts pull money from clients and invest them into a variety of instruments and projects. About 7.4% trust company funds are invested in real estate-related assets as of March, and that may undercount the sector's exposure, since it's not clear to what extent other investments like bonds and equities are also tied to the property sector. Of course, you can guess, probably quite a bit more. And there's also an even more opaque part of the shadow banking business. Here we go. The trust firm's private lending to developers. It's likely trust companies had 1.6 trillion yuan of credit exposure to the property sector at the end of March. So what we're finding out is exactly what I started the show out with, is that the entire Chinese financial system is tightly intertwined with the real estate sector. Where the real estate sector goes, their financial system goes, and that then spreads across the entire globe. The Zhongrong saga is at the end of chain reaction that began with China's property tightening. As we've been making the case, as property woes worsen, China will likely see more defaults in its financial ecosystem, to say the least. And of course, that's going to spread around the world as we're making the case, as China's deflation could spill over into a global concern. It's not could, it's already starting. As a result, Chinese economic weakness and falling prices, especially in the producer prices, are likely to spill over into global markets. Near-term good news for Western central banks fight against elevated inflation. And again, this is the made in China effect. Prices there are deflating from where they were last year. That means those deflated prices are going to be pushed to consumers all around the world at a time, as we're about to see when we get to Jay Powell's remarks, where central bankers just don't believe that inflation is coming down, or at least fast enough. And here you can see the consumer price index shown in blue against the producer price index for industrial activities in the People's Republic of China. That's shown in red. And you can see where, of course, the PPI in China goes. Consumer prices eventually follow, at least with a lag. You can see it's more kind of exaggerated, but it still has the effect of pulling down the broad CPI. And here we can see, of course, producer prices in China are indeed gone negative from this time last year, acting as a downward force to U.S. consumer prices. And China's disappointing rebound is now feeding negatively into global growth and sentiment. This has been countered by a fairly benign global backdrop and relatively strong U.S. economy. Not for long, I'll say, but there's a fine balance for risk assets, as the significant dollar strength is detrimental to, and indeed, the dollar here, you're going to see, many people believe it's going to go up. What will happen is it's going to go down first, and then it's going to go higher. We're going to make the case why it's likely to fall. Here you can see the current general activity diffusion index. Now we're going over to the Philly Fed, and just to look at a pulse of the manufacturing sector against the nominal broad US dollar index, and making the case that when there is demand for dollars through global trade or an increase in manufacturing output, which would be from an increase in global trade, the dollar should strengthen. So here you can see kind of going into the global financial crisis, the dollar shown in red weakened as the manufacturing sector slowed and contracted. You can see the dollar gained strength as the manufacturing sector rebounded, that going from around 2010 through 2015. And now you kind of look at the relationship and it makes a lot of sense. Now the belief is the dollar is going higher because maybe demand's back, but when demand turns down, the dollar's going down with it. And according to the U.S. Census Bureau data as of June, prices of goods imported from China are down 3% on average versus last year. But don't tell this to Jay Powell. While producer prices of consumer goods in China are down 5% in dollar terms. Importantly, these declines are being passed on to U.S. consumers. As I've been making the case, July marked the first time since the early days of the pandemic that U.S. consumer retail good prices declined on a 3-month annualized basis. And sure enough, here you can see that this all comes back together. We look at import price end use of all commodities across the world. That's shown in red against the consumer price index in blue. Look at this beautiful and very tight relationship here. And you can see that, of course, import prices lead consumer prices. And it would make sense because before it gets on the shelf for you and I to buy, it gets counted as an import price. Of course, there's a lag before it gets on the shelf and sold, and then it counts as the consumer price index. But here you can see the beautiful relationship suggesting that indeed the consumer price index in the months to come is likely to go down, despite the fact that central bankers just don't believe. And speaking of that, here we are at, of course, Jackson Hole in the speech. We were there live, and Powell said the Fed will proceed carefully on any further rate rises. What I want you to understand here is instead of using this data-dependent phrase, which he's been using forever, and he did say that, what he's kind of acting now is perhaps a cautious tone, suggesting that he's not entirely sure how close they are to peak rates. Of course, I'm going to show you why we're already there. You just can't see it. But nevertheless, what I want you to know is a little bit of uncertainty in his tone. Given how far we've come, at coming meetings, we are in a position to proceed carefully. Again, now suggesting that perhaps they're concerned that something's going to go wrong and soon. We will proceed carefully as we decide whether to tighten further or instead to hold the policy rate constant and await for further data. So that, again, doesn't have the same ring of confidence we've heard from Jay Powell before, suggesting that, yes, we need higher rates than that, and we're going to keep them high a long time. Now suggesting that maybe the system is starting to fracture. Maybe there's something that he knows that we don't know, or maybe he's just a little bit nervous all of a sudden. It doesn't matter. Notice the shift in tone here, perhaps setting up that the next meeting may not be a hike if we continue to see a degradation in the economic data. And some officials are uneasy about raising rates further because they expect past increases will continue to slow the economy by making it more expensive and harder for companies and individuals to borrow. Others worry that if the Fed holds rates steady, strong economic growth could cause inflation to decline more slowly than anticipated. No, we busted that myth already. Powell noted both concerns in his remarks, said his financial conditions, finally admitting to this, I think, including lending standards and borrowing rates have tightened broadly in a way that typically, I love the word typically, slows down the economic activity, and there's evidence in this cycle as well. And all this tells me is, does he even know how the system works? It shouldn't be, well, it typically does. He should say, look, it does this, and this is why. Because here, in fact, I think Powell is missing the big picture. When consumers just don't have as much money to spend, demand goes down. In a shocking way, Americans buy things on credit with money they don't have, and that seems to be more of the American way. And when that doesn't happen because the banks don't want to lend to them, well, lo and behold, demand goes down and inflation follows. Here we can see the net percentage of domestic banks tightening lending standards for commercial industrial loans to firms of all sizes against the consumer price index, that's shown in red. And what do we know? When banks tighten lending standards, and eventually with a lag because less money created causes a problem, consumer price index comes down. And it came down again during the global financial crisis. And it's coming down now, but yet the Fed doesn't believe. He also acknowledged uncertainty about just how high rates needed to rise to provide enough economic restraint. I'll make the case they're already there, and it's not about how high. Inflation-adjusted interest rates have risen to historically high levels, putting them, quote, well above mainstream estimates of a so-called neutral rate that neither spurs nor slows the economic activity in this mythical rate that, of course, central bankers are trying to achieve. But we cannot identify with certainty the neutral rate of interest because we have no clue what it is what he's telling you, unless there's always uncertainty about the precise level of monetary policy restraints. So again, I want you to see that they have no clue of how the system works at all, what's causing all the slowdown, which is indeed the inverted yield curve. Here we see in red the 10-year, 2-year, notably the 2-year very sensitive to the federal funds rate against the 10-year, which is more sensitive to economic and inflation expectations. So the Fed is artificially inverting the curve by jacking up rates, tighten financial conditions. As you can see, when the banks can't make money, they tighten financial conditions. When they tighten financial conditions, borrowers can't get as much money, less new money is created in the system, and eventually we actually have an all-out, blown-out recession or financial crisis that we now know will happen when indeed all the pandemic money is gone, and that's estimated at the end of the third quarter. Watch out, my friends. The fourth quarter could be a doozy. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.